Welcome back, Focus Learners. Today, we're jumping into another explainer, and we are demystifying the dark underbelly of the corporate world. We're going to break down the anatomy of financial crimes. So how these schemes are built, how they operate in the shadows, and most importantly, the internal controls and shields that organizations use to defend against them. Okay, let's dive right into this. We've got a really clear roadmap for today. We'll start by looking at error versus fraud, outline the prerequisites for fraud to actually happen, and then explore both inside jobs and external schemes. After that, we'll break down the money laundering cycle, and finally, look at how businesses shield themselves. Error versus fraud and the critical role of intent. To really grasp financial crime, we have to start at the absolute foundation, and it literally all boils down to one single word: intent. See, an error is an unintentional mistake. If an accountant accidentally duplicates an invoice because they were distracted after a lunch break, that's an error. It's just an unavoidable part of human nature. Fraud, on the other hand, is an intentional act. It's the deliberate use of deception to get an unjust or outright illegal financial advantage. So while literally everyone makes errors, fraud is a calculated, punishable criminal offense. Section 2, the anatomy of financial fraud. So fraud is totally intentional. What actually drives a person to commit it? It rarely just happens out of the blue. In fact, it requires what we can call a dark triad of conditions. First, you have dishonesty. The person must basically lack integrity. Second, there has to be opportunity, meaning there's an opening, usually caused by weak internal controls in the business. And third, motivation. The person has essentially done the mental math and decided that the financial rewards of stealing far outweigh the potential costs of getting caught. Almost always, all three of these prerequisites have to be present for an employee to actually cross that line. And when those three conditions line up, the risk of fraud absolutely skyrockets. Because of this, organizations have to be hyper-aware of red flags. We're talking things like management domination by one single overly powerful person, unnecessarily complex corporate structures, or just a really high volume of cash transactions. But actually, look at that second point there: personnel who never take holidays. Let me ask you, if an accountant absolutely refuses to take a vacation, is that extreme, admirable dedication or a major red flag? Well, as we're going to see in just a second, someone who won't take time off might be desperately trying to keep a massive fraud from crashing down. Section 3, inside jobs and external hustles. Let's move from the theory to the actual execution. Who is pulling off these schemes and how? This breakdown shows how different levels of stakeholders exploit a business. Right at the top, management might pull high-level manipulations, like window dressing or asset misappropriation. Down on the ground level, everyday employees might commit teaming and netting or skimming cash from daily sales. And then you have external third parties. These are the folks using false billing or advance fee frauds. You know, like those spam emails promising you a massive inheritance if you just pay a small processing fee upfront. Let's zoom in on a classic management level fraud: window dressing. This is a pretty sneaky form of fraudulent financial reporting. Think of it like a homeowner frantically shoving all their junk into a closet right before an open house, just to make the place look perfectly clean. Management might force through massive, completely unnatural sales right before year-end to hit their bonus targets. But then, come January, they issue credit notes and reverse those exact same sales. It's totally artificial and intentionally misrepresents the real financial health of the company. Now, what about the regular employees? They might use a tactic called teaming and netting, and this brilliantly illustrates how an insider can steal day one's cash and just seamlessly cover it up with day two's receipts. It works like this. The employee pockets the cash a customer pays on Monday. To hide that missing money, when a completely different customer pays on Tuesday, the employee applies Tuesday's cash to Monday's account. This creates a continuous, incredibly stressful juggling act. And hey, this is exactly why the employee pulling this off can never take a holiday. If they step away for even a few days, the juggling stops, the accounts don't match, and they're instantly busted. Okay, so that's the inside threat. But let's see how this scales when we look at external, third-party frauds. Look at this number: 40,000. Back in 1903, a guy named Charles Ponzi told investors he could literally double their money in 90 days. 40,000 people actually believed him and handed over roughly $15 million. A Ponzi scheme works by paying abnormally high returns to early investors using the fresh cash brought in by new investors, not from any actual real business profit. When the new money eventually dried up, it collapsed and investors lost practically everything. The golden rule here? For sure, if an investment looks way too good to be true, it absolutely is. Moving to Section 4, the money laundering cycle. Now, we are pivoting away from localized corporate theft to the massive macro-level crime of cleaning illegal cash. Money laundering is the act of exchanging dirty money, like funds from drug trafficking or illegal arms sales, for clean money and assets that look entirely legitimate. And the legal severity of this is no joke. In the UK, actively participating in money laundering can land you a maximum 14-year prison sentence. But here is the real kicker for corporate workers. Simply failing to report your suspicions of money laundering can get you a 5-year prison sentence. Literally just turning a blind eye is a crime. The whole laundering process happens in 3 distinct phases, and you can think of it exactly like a washing machine cycle, progressively rinsing the dirt away. Phase 1 is placement. The dirty cash is placed into a legitimate financial system, maybe by buying shares or putting cash in a bank. Phase 2 is layering. The launderer rapidly transfers those funds between multiple accounts, front businesses, or even borders to create a confusing paper trail. Finally, Phase 3 is integration. The now clean money is withdrawn and used to buy luxury assets, appearing to come from a perfectly normal legal source. So we've looked at the diseases here, right? The internal frauds, the external scams, the laundering of millions in dirty money. It naturally makes you wonder, how on earth do organizations actually fight back against these massive financial threats? Which brings us to our final section, shielding the business. Let's look at the actual shields used to protect an organization from financial ruin. The principal defense against all of this is a strong internal control system. This means implementing the segregation of duties, so the person writing the checks is absolutely not the same person signing them. It means running frequent internal audits. It involves incredibly strict KYC, or know your client procedures, to verify exactly who you're doing business with. And, connecting back to what we talked about earlier, something as simple as forcing your staff to take a mandatory 2-week holiday can instantly break an ongoing teaming and netting scheme. Now, a huge piece of this defense system, especially if you're looking at banking or finance, is a specific role called the MLRO, or Money Laundering Reporting Officer. This is a vital piece of vocabulary, particularly if you're tackling business and technology exams. The MLRO is basically the central hub for anti-money laundering in a firm. If a regular bank teller notices someone making incredibly suspicious, massive cash deposits, they don't confront the customer directly. No, they report it straight to the MLRO. The MLRO then handles the investigation and alerts law enforcement. But here's the thing. Installing these controls isn't just a set it and forget it kind of deal. Business environments are dynamic, they are constantly shifting, and honestly, the tactics used by fraudsters are evolving every single day. A control system that worked perfectly last year might be totally useless today. Because of that, internal controls have to adapt. Board members and auditors must regularly evaluate their risks to prevent fraud and protect shareholder trust. Which leaves us with one final, pretty crucial thought to reflect on. Fraud thrives on weak internal controls and complacency. So, is your organization's control system actively adapting to catch new emerging risks? Or are you accidentally leaving the front door wide open for tomorrow's fraudster? Think about it. Thanks for joining me for this explainer, Focused Learners. Stay sharp, and I'll catch you in the next one.